Complex is not always better, and in fact, it can usually get you into a lot of trouble. And so in this video, I want to go over a super simple valuation methodology that will help you figure out how to value the stocks in your portfolio right away. Now, I know I can be guilty of using the more complex methods like a reverse DCF, which is basically when you do the discounted cash flow, instead of putting in a discount rate, you leave that empty and you put in the end value equal to the current market valuation of the stock. And so in a reverse DCF, it is the market telling you what the discount rate is. And then you can change your assumptions and see what the returns will be under different assumptions. That is more complicated though. And to be honest, even when I do it, I don't always update it all the time because running that analysis can be a little bit burdensome, especially if you have a lot of different companies you want to keep track of. And so today I want to talk about a really simple way you can value a business. And so earnings multiples are a shortcut for a DCF, but you don't need to understand that right now. All you need to know is that if you take a company's current earnings and apply a multiple to it, that will get you a sort of valuation. Now, that was not the valuation methodology I'm talking about though. What I want to talk about is looking out into the future of a business and looking out into the future and thinking about what a future multiple will be, and then seeing what you think it will trade at that time. And so it is really important to know that the difference between pricing a stock and valuing a stock is that when you price a stock, you are saying what you think other people will pay for it. Whereas when you value a stock, you are saying what you think people should pay for it. And so, just for an example, let's say you're into sneakers and there's some rare Nike sneaker drop and you got lucky, you got it for $200. The market allows you to sell it for $1,000. You may say, wow, that's a lot of money, but what would I personally have paid for these? Oh, maybe no more than $300 or $400. And so don't get too caught in that example. I'm just trying to show you that there could be a difference between what you think something is worth and what other people think something is worth. And so when we are pricing stuff, it is what we think other people will believe it is worth. Whereas when we are valuing it, it is what we believe it should be worth. And this is not that abstract. It does actually tie back to the DCF and to required returns and all of that. But I want to keep this simple. And so if you were looking at a business that has a $100 stock price today, and $5 in earnings per share, then that will be a multiple of 20 times. Let's say that this company can double their earnings in 5 years' time, then that means that $5 goes to $10 in earnings. And so a $100 stock price today will get you $10 in future EPS. I said 5 years out, right? And so you take the $100 and you divide by $10 and you get 10 times. And so the current multiple is 100 over 5, which is 20 times. But the future multiple is 100 over 10, which is 10 times. Now, this is where the valuation part comes in. So you could say this stock, if they continue to grow, they're going to trade at 10 times in the future. What I believe that company should be worth at that time, for, let's say, a high quality business that has some reoccurring revenues and continues to grow top line at 5% with a little bit of operating leverage, getting them to high single digits, it should be worth at least 18 times. Okay, that is your judgment, but you're not really pricing it because you're not saying this is what I think other people will pay for it. You're saying this is what the real value of the business is. And again, you could tie this back to a DCF. And so you're saying it should be worth 18 times in the future in 5 years. And so take that 18 times, multiply it by that $10 in EPS you see them having in the future, and you get $180 stock price. Now you could buy that stock today though for $100. And so that is a very quick way you can do a valuation. And one last step to this, if you want to calculate what that return is, assuming no dividends in this case, you take $180, which is the ending price of the stock. Then you divide by $100, which is the price you're paying today, and you get 1.8. And then you subtract 1, and then that'll get you 80%. Now, if you want to see what that return is on an annualized basis, you just use this simple formula. You do ending price divided by beginning price to the power of how many periods it is. So in this case, we said 5 years, and then minus 1. And so if you do that out, it's just 180 over 100 equals 1.8. and then it's 1.8 to the power of 5, and that'll get you something like 1.125, which is about a 12.5% compounded return. And so if you didn't get that formula, don't worry about it. Keeping things super simple. All you have to do is, as an investor, you have to judge what you believe that business is going to be worth, what that multiple is going to be in the future, and then multiply that by future EPS. And then that is what your future stock price is going to be. And so I hope that was helpful. There's more complex ways we could do that, but I wanted to just give you a very quick one. If you have any questions on that, go ahead and drop them in the comments below. But if you want a more thorough understanding of valuation and really understand valuation a little bit more next level, go ahead and check out this video here.